Jason Draho is the head of asset allocation for the Americas at UBS Global Wealth Management. Besides a strong drink at the end of the day, what on earth do you make of the last 6 hours?
Well, it's certainly been unprecedented. We have never seen anything quite like what's happened really over the past week. But if we try and put stay sober for at least a little bit longer and assess kind of where we are now, in some way, where we are now with the tariffs is similar to what investors would have thought prior to the Liberation Day's announcement of tariffs last week. Everyone expected tariffs to go higher. They didn't expect them to go that high. What's been pulled back is kind of back to where the base case was for the markets last week. So positive today, but in the context of what was expected a week ago, it kind of puts us back in that baseline.
In this market, assuming that we'd seen bonds selling off, we'd seen weakness in gold. Now, both of these things were highly unusual in the circumstances, which suggested that there was strain within the financial system. What did you make of the bond market?
Well, that was really the interesting story this week, is the bond yields rising at a time when there was rising concerns about a recession. Normally yields would fall, people would flight to safety, bond yields should decline. The fact that they're rising suggests there's more concerns about perhaps inflation, about stagflation, concerns long-term about maybe deficits are going to be larger because to offset the tariffs, they have to run bigger, kind of spending cuts, or spending increases, tax cuts going forward, so bigger deficits. And there's concern about investors globally perhaps just not wanting to buy U.S. treasuries as much. So I think it was actually the bond yields rising the past 24 hours or 48 hours, more so than equity selling off, that was the real catalyst for Trump making this pivot. And during the comments this afternoon, he kind of alluded to stress in the bond markets.
Because we don't really fully understand the motivation of that bond market move, other than seeing the higher rates, which would have is costing everybody more. But actually, the mechanisms of it we don't really fully understand yet.
There could be multiple factors. I mean, certainly it's speculation exactly what's driving it. Sometimes there could be just investors de-risking and selling it. There could be technicals in the marketplace that drive yields lower. The reality is yields going higher, not good for the stock market, not good for the economy, and certainly not good from the perspective of President Trump.
So your title has asset allocation. Your job title has asset allocation in it. Tell me about asset allocation in this environment, bearing in mind the uncertainty. What should it be?
Well, what we often tell clients to prepare for and navigate these kind of environments is make sure you have a long-term plan, because there's no way you can anticipate moves of like what's happened today or what's happened over the past week. So if you think about where you should be allocated in terms of stocks, bonds, commodities, other asset classes in your portfolio, we'd say by and large right now, this is not a time to be making sort of big tilts and bets relative to that long-term allocation. Sort of thinking about, tack close to home, close to shore. Don't make big allocations, because you get whipsawed and no one can predict these kind of things. So it doesn't mean selling risk assets. It's just making sure you're allocated relative to your long-term objectives. I think that's the best way to kind of have peace of mind to kind of deal with this extreme volatility.
But if you want the safety of that fixed income, all right, I'll grant you the moves on fixed income are nowhere near as volatile or as draconian as you'll see on an equity, but they are there. They're still there. So even fixed income can give you a nasty bout of indigestion.
That's absolutely right, which is why even just last week, as this was going on, we were suggesting people, go relatively short fixed income, buy things that are less than 5-year maturity in terms of bonds, because as rates go higher, you get whipsawed, and that thing is the flight to safety, which this is the other side of that. So not really taking a lot of interest rate risk or kind of extending too far. Shorter maturity, high quality, that's kind of the best place to hide out, because it's just not going to be whipsawed nearly as much as if you buy a 10-year bond, for example.
You can plead the fifth on this next question. Is it your feeling that this is got some still way to go, that the uncertainty is still there, the tariffs could come back, we've got a new 10% tariff for everybody, China 125%, we're not out of this yet?
The way I think of it is that we've probably just passed a local peak in uncertainty, but maybe not past the kind of universal peak, the global peak. Things could get worse, but at least for the moment, there's a time to maybe for cooler heads to prevail, for negotiations to take place, to make sure we don't get back to the edge, just like we did the past week.
I'm grateful, sir. How kind of you to join us. Thank you.